Hey guys, YT Money Nerd here. This is the 5th video now in my series on personal finance. If you haven't seen the others, you can watch them by going to the playlist in the link below in the description. This one is going to be all about everybody's favorite subject, taxes. You might think you already know what you need, that everybody has to pay them. Well, there's actually a lot to taxes, and it's important that we understand how they work. I'm going to narrow down the scope of this video because when you say taxes, that can actually mean a lot of different things. You can have sales taxes, property taxes, inheritance taxes, capital gains taxes, the list goes on. But what we really want to focus on here is the all-important income taxes. No tax is going to be more impactful to you than income taxes. Income tax is part of the way that government raises money to be able to pay the costs to maintain spending programs. This is much like the budgeting that we've already talked about for ourselves, but on a much larger scale. The government can also raise money for spending by borrowing money or printing money. Borrowing money is done by issuing bonds that people or institutions can purchase and earn interest on. Printing money is another option that governments have and use quite often, but for reasons outside of the scope of this video, it's generally the least desirable way to raise money to pay for things. So now we know that the government is going to have to raise money through taxes on people's income, as well as the income that businesses generate. For businesses, the current corporate tax rate as of June 2020 is 21%. This corporate tax rate applies to the profits that a business generates. Profit is like your net savings that we talked about in the budgeting video. It's what is left of its income after a company pays its bills and its employee expenses. Okay, now for your taxes that you pay as an employee for your earned income. The way that federal income tax works in the United States is that you get sorted into income tax brackets. Just a quick note that I want to clarify is that federal income tax is income tax that you pay to the federal or national government. When people think about tax brackets, a common misconception that they have is that they think that you pay the percentage of your tax bracket on your income earned. It actually doesn't work this way and is a bit more complex. Tax brackets in the United States are actually what are called marginal tax brackets. The way that marginal tax brackets work is that each segment of your income gets taxed at a different rate. To explain this, let's take a look at the current marginal income tax brackets in the United States for the year 2020. I'm just going to quickly search from Google for tax brackets and we can easily click on the first link. Once this loads, we're just going to scroll down the page until we get to Tax Brackets 2020. We're going to do a little exercise to explain this by making up a scenario. In this scenario, we're going to talk about the wildly successful Jane Doe, who is the CEO of the fictional Moneyville Bank. As CEO, Jane is pulling in a cool $1 million salary per year. April 15th comes around and it's time for everybody to pay their taxes, including Jane. Let's take a look at how much Jane is going to owe in federal income taxes for the $1 million that she earned. The first thing that we'll look at is Jane's filing status. We're just going to say that Jane is a single filer to make the tax situation simple. In the marginal tax bracket system, we're going to first take 10% of the first $9,875 that she earned in 2020. This comes out to $987.50. Next, we have to take 12% of all of the income she earned between $9,876 and $40,125. We'll subtract $40,125 minus $9,876, which comes out to $30,249. Now we multiply this by 12% to get $3,629.88. We add this to the $987.50 that were owed on the first 10% of Jane's income to get $4,617.38 for the first $40,125 that she earned. Let's go ahead and take a look at the next tax bracket now. For her income between $85,525 and $40,126, she has to pay 22% in taxes. So we'll subtract $85,525 minus $40,126 to get $45,399. And then we'll multiply that by 22% to get $9,987.78. When we add that to the $4,617.38 that are owed on the first $40,125 of her income, we get $14,605.16. So you can see that if we continue this process of adding up the taxes owed for each marginal tax bracket, we find that Jane's tax bill is going to come out to $334,425.75, rather than $370,000 if she just had a flat 37% tax rate for all of her income. This puts her effective tax rate at 33.4%. Your effective tax rate is your tax rate when you divide what you owe in taxes under the marginal tax bracket system, divided by your income, then multiplied by 100 to get the percentage. Understanding taxes is going to be important moving forward because it will help you understand what happens when we start talking about tax deductions and tax credits. Tax credits are an exact subtraction from what you owe in taxes. This means that when you go to file taxes, you're going to have the amount of the credit added to either your refund or what you owe. For those that owe the government on their taxes, a tax credit might actually be enough to get you a refund. Tax deductions are a little bit different. For a tax deduction, your taxable income gets reduced by the amount of the deduction. This isn't quite as advantageous as a tax credit because it only reduces the amount of income that can be taxed, rather than directly reducing the taxes that you owe. What I mean by this is that if you're making $60,000 a year as a single filer and you receive a $10,000 tax deduction, your taxable income becomes $60,000 minus $10,000 or $50,000. Since this lies entirely within the 22% tax bracket, that means that you're going to owe 22% of the $10,000 difference less, or $2,200 less. However, if you had a $10,000 tax credit, you would owe $10,000 less in taxes. Again, in either situation, if you're already getting a refund, then this tax deduction or tax credit amount will get added to your refund. So let's give an example of a common tax credit and an example of a common tax deduction. A common tax credit would be the child tax credit. This tax credit is currently $2,000 per child you have as of 2020. This means that you get $2,000 added to your tax refund per child or $2,000 subtracted from your tax bill per child. One of the most common tax deductions is the student loan interest deduction. This deduction allows you to deduct the interest paid on student loans. So if you paid $1,000 in student loan interest throughout the year, your taxable income gets reduced by $1,000. If we continue the example of making $60,000 a year as a single filer, this means that your taxable income gets reduced by $1,000 to $59,000. This saves you $220 since the $1,000 difference multiplied by the 22% tax bracket gives you $220. When you're doing your taxes, you want to make sure to identify any credits or deductions that you qualify for to save on taxes owed or increase your refund. You're also going to want to consider how your financial decisions throughout the year are going to affect your taxes when it comes time to file your taxes. And while I'm talking about your financial decisions throughout the year, I should also mention something real quick about the timing of taxes. Every year, most workers have to file their taxes on April 15th. When you file your taxes, you're actually paying taxes on what you earned in the previous calendar year. So the current year is 2020, but the tax filing that I submitted applies to my earnings from last year, which was my earnings from January 1st, 2019 to December 31st, 2019. So when I say that you want to consider how your financial decisions throughout the year are going to affect your taxes, that can mean taking some actions at the end of the year to save yourself some money or increase your refund in a few months when you file your taxes. Many people choose to make donations to charity at the end of the year, not just because the holidays are at the end of the year and it's the time that people feel charitable, but also because if they're going to make donations, it's the last chance to get a tax deduction to reduce their taxable income on their next tax filing. Okay, so now let's talk about the W-4 form. For your job, you have to fill out a W-4 form, which gives your employer some directions for how you would like them to handle your income taxes. If you went through the exercise of estimating your own taxes based on your income when we were talking about tax brackets earlier, you might have noticed that the taxes you owe are far higher than what you paid when you filed your taxes last year. Or you might be wondering why you got a refund when the taxes owed that you calculated is thousands or tens of thousands of dollars. Well, this is because your employer typically withholds taxes for you based on that W-4 form that you will fill out for them. If you didn't do this, you would get hit with a massive tax bill every year when you file your taxes. Many people would spend their money they earned throughout the year and have nothing or very little left over to pay their taxes. The W-4 form has changed in recent years as part of the tax reform measures in the Tax Cuts and Jobs Act passed into law during the Donald Trump presidency. For those who anticipate having to fill it out for a new job, there are some differences to be aware of. You're going to have to do a little bit more math to fill in the fields, especially if you or your spouse work multiple jobs. The one piece of advice that I'll give you is for step 4 where it says other adjustments. You are going to have to make some decisions here. If you have income sources that don't have tax withheld, such as stock dividends or anything that pays you interest, you might want to account for the taxes that you'll have to pay for those income sources here. If you don't have much in savings or aren't good at planning for a tax bill, you might want to add extra withholding in this step. On the contrary, money in your pocket now is worth more than money in your pocket later. Adding extra withholding basically means that you're giving the government more money up front so that you can reduce your tax bill later or increase the size of your refund later. The thing about this is if you're savvy with your money, you can invest it in something that is going to generate some return for you now rather than give it to the government and wait for them to pay you back or keep it to cover your tax bill. This is really a judgment call on your part how you'd like to handle it, but the most efficient way to handle this is to not have any more money withheld than necessary and put that money to work for you until your next tax filing. Let's also talk quickly about anybody who is self-employed. If you're self-employed, you're not going to have the same style of tax withholding in a paycheck. What you're going to want to do is pay estimated quarterly taxes. This is accomplished by filing a 1040-ES form with the IRS each quarter of the year. You can find this form on the IRS website. Failure to do this can result in you having to pay additional tax penalties beyond your regular tax obligations. So make sure to file this 1040-ES every quarter and to do your best to not underestimate what your earnings and resultant taxes will be. So now I've covered federal income tax, but depending on where you live and work, you might also be required to pay state or local taxes. Most states have a state income tax that helps to pay for the state spending budget. Some cities also apply an income tax to the workers that work within their city limits. There's no way that I could go over every state and city's income tax system, but generally states and cities that require you to pay income tax either have the same type of marginal tax bracket system as the federal tax system, or a flat tax that is one consistent percentage of your income where everybody regardless of income level pays the same tax rate. If you're unsure of how your state or city's income tax system works, I would encourage you to go research on your own. There's one last thing that I want to talk about before we finish up. I want to make sure that you understand what the taxes are that you pay in your paycheck. If you look at your paycheck's earnings statement, you should see a few different tax deductions. There are 3 things that most everybody should see. The first is a line that says something along the lines of federal income tax or federal withholding. This is the federal income tax that we've already talked about that gets computed using the marginal federal tax bracket system. The next line is something that says Social Security tax or some variant of that. This is what you pay towards the Social Security system. The way this works is that when you pay tax into Social Security, you're actually paying for current Social Security recipients' benefits. As you earn throughout the course of your career, you build up credits for your own Social Security benefits when you become eligible to collect Social Security. The third line that you'll see is Medicare tax or some variant of that. This is what you pay towards the Medicare health insurance system. This works in the same way as the Social Security system. Collectively, Social Security and Medicare taxes are known as FICA, which stands for Federal Insurance Contributions Act. The FICA tax was originally introduced in the 1930s as a tax to fund President Franklin D. Roosevelt's Social Security program and later increased in the 1960s to fund Medicare. These are both flat taxes that are a constant percentage for all taxpayers. Depending on where you live, you may see some other state or local income taxes deducted from your paycheck. Alright, that's going to wrap it up for this video. Hopefully you've gained a much better understanding of the income taxes that you pay and how they're calculated. If you found this video helpful and you want to learn more about personal finance topics, please like this video and hit the subscribe button below. This is YT Money Nerd, signing off.